thank you to Andrea for joining us from Boopos. Boopos is a topic that comes up often in our Slack group, right? And what it is, it's an alternative-based lender. And members ask all the time about other forms of lending because we stress SBA so much in the program because that's what so many people use. But there are other non-SBA lending options, right? And Boopos is one of those options. And so Boopos does specialize in SaaS and Ecom deals, but there are other revenue-based lenders that specialize in other areas too. And so I just thought this would be a really good opportunity to bring them in and talk a little bit about what revenue-based lending is. I'm going to let Andrea kind of introduce herself and give a background as far as what her role is with Boopos, and then she and I are just going to have a conversation. If you guys have questions as we're talking, feel free to put your hand up and we'll get you in as we converse, or you can hold your questions to the end. I don't really care. Andrea, go ahead and introduce yourself if that's okay.
Yeah, thank you, Chelsea. Well, thank you everyone for having me today. It's a pleasure to meet you. I'm Andrea, as you can tell in Spanish. I'm right now in the US. Our company is American, and most of our clients are also here based in the US. So it makes more sense for us to be here. We work with people worldwide. We've been doing so for the last year. So we're fairly new in the space. We started Boopos around a year ago, basically because we realized that it was very hard for entrepreneurs like yourselves and managers to raise the capital to acquire online businesses. And that's what we did. That's what we started to do. That's what we've been doing so far. We help people acquire e-commerce and SaaS businesses by financing up to 80% of the acquisition price through this revenue-based lending model that we're going to be talking about today. I myself joined Boopos 4 months ago. So I'm also a little baby here in the company. I come from tech environment myself. I was in San Francisco before. And the thing about Boopos that brought me here was that it has a very unique product that you can really see how it's helping people acquire their goals and their objectives through financial freedom, basically. While they minimize risk, they can suddenly, with just 100K, for instance, go after deals that are 600K, or they can leverage the money they have. So it gives us this opportunity to really connect with buyers from this ecosystem. In particular, I'm an origination manager here, so I'd be the person that would be guiding you and assisting you throughout the process.
That's really, really helpful. And so can we just kind of open the floor with, there are a couple of different situations, right, that allow for alternative-based lending. And so when you're thinking about funding something, whether that's, I'll let you kind of run down the options, right? Because frankly, I'm going to minimize my talking. I think that will benefit everyone with my scratchy voice.
Yeah, so when it comes, we have two topics here, right? We've got the topic of revenue-based lending, and we have the topic of how to fund an acquisition in the online space. Going from bigger to narrow and down, when we talk about the funding and the options you have out there when you want to acquire an online business, you guys know it. You've probably slacked about it a lot, as Chelsea was saying. You can go to the bank, you can try to qualify for an SBA loan. However, when it comes to online businesses, the first problem is that it's not always easy to qualify for an SBA loan. Traditional banks can be very skeptical when it comes to an e-commerce or a SaaS business. They don't really speak that language. And then when you do qualify for an SBA loan, it takes forever to get funded. The online space market moves extremely fast. The good deals just go away very fast. There are aggregators that have the money up front. There's a lot of wealthy people that can just come and, hey, pay 3 million and take the best deals. So having to wait 6 weeks for an SBA loan, for instance, that might mean that you've lost the deal. And then if everything aligns and you get the deal, it will of course come at the risk of having to give personal guarantees, which is of course not ideal, especially in this space and especially nowadays. You don't know what will happen. You don't know if you're going to lose what's going to happen with COVID, with supply chain, with Ukraine all of a sudden. So not knowing if you're going to make it or if you're going to lose your house in 10 years, that was not ideal. Then other funding options, more traditional, that you could have when you're looking to acquire an online business, that could be venture capital or venture debt. Now, again, this will take a long process. You need to convince them, you need to pitch, you need to build your storytelling, your business plan, have a proper startup in place. And of course, it will come at the cost of diluting yourself. And if we're talking about venture debt, these guys are pretty expensive. So we saw that there were no real options for entrepreneurs to acquire an online business in the terms of no personal guarantees, no equity dilution, and flexibility. That's why we took the revenue-based lending, and that's tapping onto your second question, Chelsea. That's why we took that revenue-based lending model and applied it to the M&A space. Now, when it comes to the revenue-based lenders, usually it's online platforms that are doing the same model. We've got a lot of players out there. You've probably heard about Pipe, for example, CapChase, YFlyer, etc. All of these guys out there are using this model, which basically means we lend money, and the way to pay it back is through a percentage of revenues until you pay back the debt. These other guys are doing this for working capital. So they're doing this for growth. If you acquire an online business and you want to invest in marketing or inventory, these are the guys you probably want to talk to. However, they do short term. So 6 months, perhaps they stretch it to a year. So at the end, their IRP is also quite high. When it comes to Boopos, we're the only revenue-based lenders that are specialized in acquisitions. That's our big point of difference, and that's why it's so valuable for a community like yours. Being the only ones that are specialized for acquisitions also means that our terms are slightly different, in the sense that, first of all, we're the only ones that are going long-term. So we go up to 5 years, and then we're the only ones given bigger facilities. As we were saying at the beginning, we can finance up to 80% of the acquisition price. That doesn't mean, to be very honest and very transparent, that we always go that high. Of course, it will depend on the deal, but we have that capability. And we have a cap per deal, not per buyer, of 1.5 million, which we're looking to stretch in the near future. And I mean, we have the financial partners backing us up. We have an objective to deploy 100 million this year. So it's clearly a product that's working so far. And there's a niche for it as an M&A space for online businesses and revenue-based lending model.
So can you talk us through how it works exactly? So if I have a business that I'm interested in, and this has worked for a couple of our lab members, which is how I brought you guys here, but can you just talk about how I guess what the whole process looks like, kind of from start to end, and how it all works?
Yeah. I'm glad you bring up the lab members topic. I was just telling Chelsea when we first connected, I'm like, hey, I finally meet you. I've jumped on so many calls from people being like, Chelsea, talk to me about you, but I still haven't met Chelsea. So yeah, thank you for all of those recommendations. Basically, the process can start from 2 ways. It can be on a more proactive way from the buyer themselves. So now imagine you guys find a deal online that you're interested in. You can submit it through a platform. We have a very simple form. And with just a profit and loss statement of the last 24 months broken down on a monthly basis, and the link to the e-commerce, if it's an e-commerce store, or a cohort triangle analysis, which will give us some kind of idea of the recurrence when it's a SaaS business. With just these 2 pieces of information, we can produce a term sheet and give you feedback in just 48 hours. So it's pretty simple. The moment we get your sign up on the website, by the way, if you struggle or something, don't worry, because our team, the origination team, gets a notification, and then we're very fast in reaching out and being like, imagine Ankit, right? Hey, Ankit, do you need help? I've seen you signed up. If you need anything, you can book a call with me. So that would be the first way, when you guys just see a deal and you want to know how it will look like if you had a financing and how could you structure it with us. The second way is more of a passive or more of a comfortable way. At Boopos, we work with almost all of the brokers out there. So we work with Empire Flippers, Website Closers, F International, Flipa, name it, we're probably there. And if we're not there, please name them, because we're missing out. All of this, guys, they source us deals on a weekly basis. Our underwriting team is analyzing hundreds of deals on a weekly basis. Those deals that do not belong to a specific buyer and have just been sourced by brokers so that they can have the pre-approved financing tag on their website, we post it on our own listings page on our website. And that listings page, you'll find a selection of SaaS, e-commerce, D2C, and FBA businesses that already have pre-approved funding approved. That's mean that the moment you click on more information and put your email, you can get a term sheet. Once you do that action, if you're a new buyer in our system, you'll still get a message from an origination manager because, hey, we want to get to meet you, want to get to know where you come from, what you're doing, what are your needs, etc. And once you go through this very brief introductory call, which will be with me or with any of my colleagues, we immediately grant you access to our financing options. So whenever you see a deal in that listing space, you can just get a term sheet very fast. We'll connect you with the broker. And in just 7 days, you can get funded on our end. So we really work very hard to not be the bottleneck, because we understand how it's important to be fast in the online business market.
So what do you guys, when you're looking at listings, I guess, what are your, every lender typically has criteria, right? You need to have this, 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 and this. And so do you guys have criteria like that? And if so, what is it?
Yeah, good question. And it's pretty straightforward. General terms, we're looking for profitability because, of course, hey, we're lending 5 years. We tend to take most of the risk. So we want to make sure that the business will be sustainable for at least 5 years. So the minute you have a deal that has been approved by Boopos, you know that from the financial side, within that's sustainable enough. So that's what we ask for, the 24-month profit and loss statement. Then on the other hand, we're looking for recurrence when it comes to a subscription-based business. That's why we ask for the cohort triangle analysis that will give us an idea of the lifetime value of the subscribers, their churn rates, etc. When it comes to e-commerce or an FBA business, we take a lot of attention into the link to the e-commerce or the storefront. Our underwriting team has tools that are able to extract a product positioning score from the storefront itself. That gives us an idea of how competitive the product is, how popular it is, the reviews, etc. We combine both pieces of information, financial and product positioning. That gives us a score from 0 to 2. Anything above 1.2, more or less, we consider it to be solid enough.
Perfect. And so you're working in the ecom and SaaS space specifically, but I also heard, or did I also hear, not just ecom. I think we use the term ecom sometimes referring to online businesses.
Okay.
And so is it online as well, right? So there's content companies and, you know, like their own websites that are selling things. And so is it ecom only, or is it kind of any online business?
Okay, so again, very good question. E-commerce, anything that's profitable and solid from a product positioning, it's good. D2C or Amazon. When it comes to those other kind of online businesses, to be very honest with you guys, we're working on that. So like our underwriting model is very solid with e-commerce, SaaS, and FBAs. We're starting together with content sites. We're starting to do a few tests, but we're still perfectioning the model. So we'll go a little bit more shy on e-commerce. We'll lend fewer, like less amount and on those sites, etc. And we're starting to approve them now. Same with KPA, I think it is, the ones that are Kindles. I'm never able to pronounce that. Yep. And then same with affiliates. We're not quite there yet. I know we're in the process of studying them, but I wouldn't recommend submitting an affiliate or an agency right now yet through our process, because highly chance it will not get approved by yet. Unless we get more information and we talk about it and we get some feedback. This is an ongoing conversation. We also learn from you guys every day. So any good piece of advice to help us improve our model is always welcome.
I'm going to go to Gotham for a question in a second. Just to clarify, since this video does live in infamy, is we're seeing more companies that are service-based businesses that have gone fully remote being sold as online businesses. And so they might be a B2B service model, right? Where they're selling a service, it could be recurring. And so that would be another area not to play with for Boopos right now, correct?
If it has a subscription-based service, we could look at it in the sense that I'm guessing our subscription-based underwriting could apply.
Okay.
Absolutely. Thank you for that question, Gautam. If you want, Chelsea, after this call, I'll also share with you a one-pager we have that shows an example of what a typical payback schedule would look like. That might be very useful to the community to understand what I'm going to explain right now. Yeah. Guys, if anyone has a question, again, just jump in. I'm going to answer to both your questions at once, starting with the percentage of revenue question. That percentage of revenue, we call it the royalty. This royalty, we establish it on a case-by-case basis. So I wish I had an answer and I could just say, we take 20% of revenue or 8% revenue or 90% revenue. But to be honest, I don't have it, because it depends very much on the amount we're lending and the nature of the business itself, that financial track record. Now, again, taking one step back, we do not take any personal guarantees. We do not ask for any equity. So the only thing we're looking for is to get paid back. That is through this percentage of revenues. This percentage of revenues, which we establish depending on the amount we're lending and the nature of the business itself, varies completely, as we were saying, on a case-by-case basis. Important things to know. You know upfront how much it will be for that deal because you have a term sheet that we can talk about before you accept the term sheet or you go over your LOI or however you want to do it, the process up to you. And for establishing this royalty, even though it's established on the gross revenue, we always take into consideration the net profit. And that's a concern that a lot of buyers have. Will it drown the business? Will it be cash restrained? We make sure there's always a margin for you to be able to reinvest in the business and grow that business. Of course, if after 1 year, for instance, you want to apply for a growth loan because you want even more money, we're your financial partners in this. We're happy to talk about it. We're happy to help. But for the start, since the first moment, we always take into consideration that that percentage of royalty will allow us to get back our money at the end of year 5. If the business stays flat, or if there's even a case of losses, so like worst case scenario, we're still getting our money back and we're not drowning the profit of the business, because otherwise what's the point, right? So to answer this first question, royalties depends very much. I've seen royalties as small as 8%, 8, not 80, 8%, have an accent, sorry about that, 8%. And I've seen royalties as big as 60%. And SaaS, where margins are way higher, multipliers are also higher. So it balances out. It's very fair. To reply or to get back to that second question you were asking, the cost of capital. Now, another very interesting thing about Boopos is that besides having this payback that's flexible, that goes with the profitability of the business, no phase installments, is not a mortgage. We're also not a bank, which means that we do not have prepayment penalties, quite the opposite. We've designed a payback schedule that has prepayment discounts or bonuses, like I like to call them. This basically means that the final cost of capital will depend on when you give back the money. So if you pay back the loan on the first year, it's 15% the amount you lent, or we lent the amount you borrowed, right? So that first year, imagine that you've grown the business, you've already paid most of the loan from the royalties, the remaining balances, that like the remaining balance would be the amount you borrowed times 1.15 minus what you've already paid from the royalties. Now, if you take the loan to year 2, the threshold you have to reach to be debt-free is 1.30 times the amount you borrowed. Year 3 is 1.40, and then from year 4 onwards is 1.60. So yes, upfront, we're more expensive than a regular bank. Of course, we take most of the risk. We allow you to leverage, which is something very interesting. A lot of buyers that we work with that are looking to do a roll-up strategy, for example, they prefer to take the loan to the end of year 5, for instance, because we're never going to ask you what you're doing with the remaining cash. They can invest in acquiring another business and growing the businesses they already own and cashing out if they want to. As long as we're getting our royalty payments, the money is all yours. Other buyers would rather just pay off as quick as possible and forget about Boopos. That's also totally fine. We're just trying to be useful here. And then, of course, by the time you get to year 5, the biggest chunk of the debt you've already been paying off for the past 5 years. So it's almost automatically that you just pay off the debt, or at least that's the idea of the model. Yeah, I love that you asked that. That's my favorite question, just because it gets challenging. Okay, so it is a secured loan, guys. The only security we're taking, however, is the assets of the business being acquired. That means that if you have 5 businesses, those businesses are safe. That means that no matter what happens with COVID, your house is safe. Your car is safe. Your credit score is also safe. Like all of that is safe. The only thing that would be in trouble would be the business you acquired with us. However, let's define, what does it mean that you're not paying us? What is the covenant we have? For us, a case of default is that revenues have been decreasing more than 20% year over year for the last 5 consecutive months. So for 5 consecutive months, revenues have been decreasing 20% year over year. So hey, this is catastrophic. We're talking about a default. In the case of default, that's when we would be entitled to take over the business you acquired using our money. However, do we want to do that? No. We're not operators. I can assure you that I have no idea how to run an e-commerce or a SaaS business. So what would really happen in real life would be that we would open a negotiation period in which we would sit down with you and say, hey, what is happening? Why have we seen this case of default? What plan do you have in place to rescue the revenue? And then at the end of the day, we'd have to restructure the debt, bear that part of the downfall. Worst case scenario would take over the business. But again, that's not our objective at all.
No, I think that's really helpful. And Gotham, you asked a couple of questions that I was just about to ask. And so I think one thing that you'll see in the lab, as you all know, as lab members, is we're very transparent membership base. And, you know, as the people that run it, we're also very transparent, right? And so I've seen term sheets being shared and people being very confused because one person's financing will be like 44% of revenue and one will be like 8% of revenue. And it's important for everyone to know, which is why I would say, like, go have a conversation with Boopos, because one business will afford a 40% revenue sharing model, whereas the other one will not. And I try to explain that it's not in Boopos's best interest to create loan terms that are going to work against either of you because they want their money back, right?
Exactly.
And so there's a certain level of, I guess, question that comes up when you see those different deals, people talking about different types of terms they received. And so it's worth having a conversation with. My question to you, Andrea, is that percent revenue sharing ever negotiated? Like, is it Boopos gives you, this is what we're gonna do, and it's like best and final offer first off, or is that a point that our members have, like a, hey, I'm not really comfortable with this number because of this model, can we do this instead, kind of a conversation?
Yeah, very honestly, yes. And maybe my boss hears me now, he tells me like, we don't want everyone trying to negotiate absolutely everything. But very honestly, guys, the good thing about Boopos, and also the reason why I feel so comfortable working here, is that we do care about your objectives and your financial needs and where you're going after. That's exactly why we have the origination team. That's exactly why the minute you start the process, you have an origination manager. I'll leave you my email in the chat after this. You can contact me directly. And as origination managers, we're always going to accompany you. Is that the correct verb? We're always going to walk you through the process, and we're here to listen. So it's true, also very upfront, that we always try to max out the amount that we can lend for every deal to be as useful as possible, the most useful you can get, with the minimum royalty. So those royalties are usually already extremely adjusted. However, ways we have around those royalties if you don't feel comfortable. The first one is very simple, very straightforward. You don't have to borrow that much. Perhaps you don't need that much amount of money. If you just decrease the facility, the royalty will also decrease proportionally, because again, it's a financial calculation. We're just trying to balance that we're gonna get our money back without drowning the profit of the business. So that's very simple resource. Hey, maybe I don't need 500, maybe I just need 450, royalty will decrease. I feel I can breathe a little bit more, perfect. Second way around it, it's a little bit more complex, but it's also possible. We've done this before, it works. It's a second tier royalty. What this means is that we'll sit down with you and we'll say, okay, if you're able to grow the revenues over this amount, any cash that comes into the business over this amount, over this threshold, will have a lower royalty. So at the end, the blended royalty will also decrease. And again, it's encouraging growth and trying to be as useful as possible.
Yeah, that's really helpful. And again, also why I can't tell you how many times I have conversations with our members to say, well, have you done the math yet?
Yeah.
Right? Like all of this, guys, like I was just on another call with another member today saying, you need to go get a partner who can help you with financial modeling. Like you guys shouldn't be buying businesses where you haven't modeled out performance, right? And so I would imagine that if you end up having some very clear growth plan that's going to cost this amount of money to infuse in the business, if you can come back and say, well, this is my plan, then that's probably where this tiered thing would come into play, right?
You asked, again, we're not SBA, and there's a reason for that. We can finance buyers all over the world, businesses all over the world. The only requirement we have is that you establish an LLC in the US or UK or Canada or Ireland, let's just keep it to the US for now for the sake of this conversation, that you establish that LLC in the US so that we can transfer the funds there. It just makes our life easier because we have everything legally prepared, ready to go if you establish that LLC in the US. Diego, we've worked with a lot of buyers that are not American. We've also worked with a lot of buyers that do not even live in the US, that are in Europe or in Israel or whatever, and that are acquiring businesses all over the world. It's very easy to establish that LLC in the US, and then we just transfer the funds there.
That's a great question. Thanks, Diego. I'll send some people your way because we typically don't.
Yeah,
Diego's one of our case-by-case international folks because, you know, I liked him and he needed help. But I don't typically allow people to come in that we can't help, like if they can't buy. And so that does open the door for quite a few people that I talk to international where they're like, well, I want to buy a business, but I don't have the SBA. I'm like, well, I wish I had a wallet I could give you, but I don't, so I can't help you. So that's something you and I can talk about later.
For now, we've worked on 50 deals and all of those are they're doing well. They're doing quite well. We're getting our royalties paid back. They're doing well. So for now, it hasn't impacted. We still haven't had a case of default. Ask me again in 1 year and maybe my answer changes. And then we're all learning on the way. As we were saying, we have that security, etc. But for now, we do take a lot of pride on our underwriting model. And we do take into consideration not just the 24 profit and loss statement, like the last 24 months, but we also look into like the most recent performance. When we see that something like that might happen, we don't approve it. We don't want to risk it. So for now, we've been very safe.
So SBA, for example, is having a hard time approving any deals that experienced a dip during COVID and hasn't fully come back. Like if they've come back 70% of their prior performance, they're having a hard time getting that approved. So I think he's asking is like, if a business was negatively impacted by COVID, but has started making their way back, would that be a problem for you guys as well? I think that's what he was asking.
Yeah, we'll look at the average. Like we will
Okay.
just look at the average. We won't take into consideration if it's COVID or not. We'll just look at that 24-month profit and loss statement. And in fact, if the growth has been significant in the most recent ones, that's something positive to take into account. Like, hey, this is growing. There might be an interest. They're running it well. However, so no, it doesn't really influence our decision at all.
Okay, so my next question is really just around, can you break down what some of the challenges are with revenue-based lending, as well as some of the advantages of revenue-based lending?
Yeah. So let's start with the difficult part. Let's start with the challenges. The challenges, I think, at the end of the day is, and to be very honest with you, that's a tricky one because we get a lot of positive feedback. The strongest challenge that we get as feedback from our buyers is the idea that a lot of people freak out when they think they have to give 60% of their revenues every month. Now, again, as Chelsea was saying before, do the financial modeling. If we're lending against the business and we're taking most of the risk and we're going long-term, it's because we do think that it's sustainable and we're leaving that margin for growth. However, maybe the buyer doesn't feel comfortable with that and they rather just, if they qualify for the SBA loan, go for that SBA loan at the price of risk in their house. That's fine. I mean, at the end of the day, that's fair. Also, we're a little bit more pricey, as we were saying before, right? So like SBA loan has very good terms. They go 10 years, we could do 5 years. Our IRP is a little bit higher. It's between 15, 20%. But again, as a buyer once told me, she said, hey, I like it because you pay for what you get, right? So, and this links into the advantages. Why do buyers prefer to go with Boopos even when having been qualified for an SBA loan? Because we've had several of those cases. The first one, very straightforward, and it's the one I always emphasize more because I know it's the one that would personally stress me more, would be the PG's part. At the end of the day, if the acquisition you did with Boopos doesn't work out, you still have a second chance. You're not losing your house. You're not putting in risk your family or your personal assets. You have a second chance. You're losing an investment you did, but that's everything you're losing. And if you exit it and you've paid us off, all of the benefits for you. So if you just invested 100K and you grew it and suddenly you've sold it for 1 million, all of that money is for you. We don't want anything to do with it. So that is the biggest advantage, the no PGs, the no equity dilution. Then that's the idea that you can leverage the capital. Very useful if you want to do a roll-up strategy, for instance, or if you've already acquired another business. And then there was that point you were mentioning before, Chelsea, and it's that we're not only your financial partners, we're also partner in analysis. So we still expect the buyer to do their own due diligence and to check the numbers. Of course, there's no way you're getting rid of that part of the process, guys. Due diligence is a must. It's like math class when you go to high school, you have to go through math class. But you still have our underwriting process, which a lot of buyers find very complementary to their own due diligence. Because again, if we're lending, we think it's sustainable. And when we're not approving it, we'll always say, hey, Ankit, we're not approving this because we've seen revenues decrease a lot in the last 4 years, for example. We are lending against your assets, correct? But it's just the assets of the business you acquired. And again, that's the only security we take. So we have to protect their back somehow. So we would be that shadow until you're paying back. But then again, we're not operators. We're not want to run the business. And then remember, you can pay us back any point in the 5 years. You can pay us back in 6 months if you want. Like, that's completely up to you. And once you pay us off, the business is 100% yours. We're not going to influence the decisions. Like, we're not going to try to influence any decisions you take when doing the business. We just give you the money and then you go do whatever you want with the business. Then you just pay us back the money on a monthly basis. Very easy. We'll connect with merchants accounts in case anyone's wondering. During the closing process, we'll connect with the merchants accounts. And then upfront, you've signed the term sheet, you've agreed to the royalty, upfront that every month will be taken, let's say, 15% of the revenues. So around this date, 5, 6 first days of the month, you'll get a message from our head of finance saying, hey, Gautam, this is the equivalent of this revenue, of this royalty for this month. We're going to be taking this. We always give a period for you in case you want to say something like, hey, this is not entirely correct or whatever. And then we just ACH automatically. And that's just the way to pay back the loan. Once you pay back the loan, you forget about us. We're not the owners at any point. The business assets is just a security we use. But then again, we're not operators. If there was a case of default, we'd sit down with you, try to understand what's happening and rescue that revenue. Because otherwise, we have the big headache of having to sell that business, and we do not want to do that either. The loss is ours, it's not yours. But taking in mind one thing, since it's a percentage of the revenue, and that's also like the interesting thing of the revenue-based lending model in general, even if imagine you're just making 100 euros, we would be taking 5 euros. So that you're always paying something back because it's a percentage. This means that if 1 month you're increasing your sales, you're able to pay back a bigger chunk of the debt. It doesn't mean that you're paying more. It just means that you're paying back faster. If another month your sales are not as good, since it's a percentage of the revenue, you're just going to be paying less. And that might slow down the time in which you pay back the money. But between us, small spoiler and small insight into our underwriting team, when we evaluate businesses, we always take into consideration flat performance scenario, even loss scenarios, to make sure that that percentage of the revenue will still make you be able to pay the debt at the end of year 5. So we do contemplate that scenario.
Because I was following and then I got lost and I think I'm following again. So okay. Gotham, let's say you're buying a company for $100,000. You're obligated to pay back the $100,000.
If that's what he borrowed from us.
Yes. Correct.
Okay, but, so the company could be 125 because he still has to put that 25% of our lending amount, the correct. Purchase price. Okay.
And I think what was being asked, if you were to grow this company astronomically, so you have like 600% growth the second year, that doesn't change the amount that you owe, right? You just have the potential of paying off the loan really fast because 5% of that sales would pay down that account. But it's not that the amount they owe you is variable percentage.
Exactly.
It's that the payment is you're obligated to that payment amount. But it's a flat rate loan.
Let's imagine we're looking at an e-commerce business that does a revenue of 1 million. It has a profit of 300 and it is being sold at a 3-something multiplier. So purchase price 1 million. So first thing we'll do is we will look at this business, we'll underwrite it and we'll say, okay, Gautam, we can give you 700K. So we're going up to 70% of the acquisition price. Now, the second thing we will do is we will establish the royalty. This is the magic word here. This is the percentage that we will be taken from your revenues every month until you pay back the loan. This is the royalty that changes from deal to deal. Because again, it depends on the amount we're lending and of the nature of the business itself. This royalty is a unique payment. So every month, you're just paying this percentage of your revenues. For the sake of this example, just to make our life easier and numbers simple, we established 22.5%. Now, assuming that worst case scenario in which you're not able to grow the business, okay? If the performance stays flat, 22.5% of annual revenues, 1 million, that would be an annual royalty of 225. If we break this down on a monthly basis, that would be around 18K every month. Of course, what happens in real life? If 1 month you grow the business, maybe that month you're paying 25 just because there's more sales, percentage is bigger. If another month sales are not as good, you just pay less. That's fine. That's the whole point of revenue-based lending. You're not hipotecado. It's not like a mortgage in which you're like stuck to a fixed installment. That's the next step here. Okay, so this is the second part of the one pager. Okay, we establish this 5-year period of time for you to be able to pay back the loan. Now, as we were saying before, you have two options, completely up to you. You can take the loan to the end of year 5 and leverage the capital, or you can pay off any point in time before that and take advantage of the prepayment discounts. This will answer your question. How does this scenario work? What is the final amount I have to pay, right? That depends on when you're paying back the loan. So imagine we are at the end of year 1, and we're going to go year by year. Imagine we're at the end of year 1. You've already paid 225 in royalties because that was the only obligation you had, that percentage of revenues. And for this example, it was flat performance. So 225 to 22.5% of 1 million in revenue. Royalties, you've paid 225. This you've already paid, you forget about it.
Yeah.
Now the threshold you have to reach in year 1 to be debt-free is 1.15 times the amount you borrowed. So for this example, it's 1.15 times 700. So that threshold would be 805. 805 minus 225 that you've already paid, you would just have to pay 580, you're debt-free.
So that means that 1.15, just to be clear, that's 15%.
Exactly.
Yeah. Okay, great. Okay.
Now, if we take it to year 2, now the threshold you have to reach is 1.30 times the amount you borrowed. And these multipliers are fixed, guys, for every deal. This is the same payback schedule. So year 2, it's 1.30 times the amount you borrowed. For this example, 910. Now, the good thing about the model is that you've already paid for 50 automatically on royalties. So now the amount you have to prepay is less, it's 460. It's not 580, it's 460. It makes your life easier. You just pay this, you're off. If you want to carry the loan to year 3, now the threshold you have to reach is 1.45 times the amount you borrowed. But again, all of this is already paid off. So now the remaining balance is decreasing and decreasing, 340. And when you take the loan to year 4, that's the cap. So the maximum multiplier you'll ever be paying for the amount you borrowed is 1.6. So you know upfront that if you borrow 700, the maximum you'll ever have to pay back is 1,120. By the point you get to year 4, year 5, you've already paid most of the loan back through royalties anyway. That's why we say that this model is very useful for both cases. Buyers that are looking to leverage the capital, as well as buyers that just want to pay off as fast as possible and forget about us.
My last question was really just if they're thinking about doing alternative lending, specifically revenue-based lending, is there anything that they should be considering as they're reviewing deals kind of in the initial review? Like, is there any criteria they should be looking at? And then I actually have a follow-up question that I just remembered.
Okay, cool. If you're looking to work, I cannot talk for the other revenue-based lenders out there. Again, all of those other revenues-based lenders, they do work in capital, so it's a completely different case. I know some of them are starting to do also a little bit of acquisitions, but they never stretch it to more than a year. So upfront, their fees might look lower because I think they charge between 8%, 10%, but the IRP will be way higher because if you have to pay with a 6% fee in the first 4 months, ARP is like 18%, 20%. So it's still cost-wise, it's pretty much the same. We might be a little bit more expensive because we're going long-term. Again, I think it's worth it, but that is completely subjective. Now, if you want to work with Boopos, then to answer your question, Chelsea, things you should look at. First of all, Think about it. Like, do you want to work with Boopos? This is a model you like, and I'd love to hear your thoughts about this in just a second. Second of all, if you like how it sounds, if you want to talk to me more often, and you want to start working with us, first thing would be check out the business. Make sure it's on our lending scope. So again, we'll lend for e-commerce, D2C, and Amazon. We'll lend for subscription-based companies, basically SaaS. Business models that we're not quite there yet. Content size, we're getting there. I think we're very close. We've been approving a few, but there's no guarantee we're going to approve it. Affiliates, agencies, all drop shipping also, we won't do that yet. That's our gray area. Categories, we can do almost everything that's out there. We just feel very unsafe when they are categories that depend a lot on trends, or in which Amazon can just throw a cheaper product and then the whole model is out, such as basic electronics, jewelry, fashion and apparel, or supplements, which might also be categories that other buyers don't really want to consider because it has that risk factor to keep in mind. That's also why we don't want to consider it. Then look for at least 24 months of lifetime of the company. That is very powerful in our underwriting model. We might still approve something that has between 18 and 24 months, but it's going to be harder. Anything below 18 months, it's not even a fit for a model. We don't have enough insight into its historical background to approve it. And just check out that it's profitable. When it comes to lending sizes, a lot of people ask, what is the minimum you do or the maximum you do? We don't really have a range. Our average ticket is around 400, 500, but then we can go as low as 100K. It just doesn't make sense for us to lend up anything below 100K. You don't really need us for that. And then we can go as high as 1 million, 1.5 million, depending on the deal. Again, looking to stretch that. So if you see any company that you think can fall under those scope, feel free to reach out to me. I'll add my email on this chat group here right now, and we can schedule a call. We can get in touch. We can look into it. Again, we're very fast, so the feedback would be quite ASAP.
Thank you. That presses my next question, which was just to refresh. You had mentioned in passing that you guys have a $1.5 million cap per deal, not per person.
Correct.
So can you talk a little bit about kind of, obviously that's attractive for people that want to do multiple acquisitions. So can you talk a little bit about that?
Yeah, absolutely. I mean, she just explained that herself, so I'm just going to repeat what she did. But that's the thing. We have a cap per deal, not per buyer. So in fact, we're very attractive, as she was saying, for people that are looking to do a roll-up strategy. Because imagine that you now have 300K pocket money that you want to invest in acquiring companies, right? Instead of investing those 300K in just acquisition of one company, you can suddenly acquire 3 companies and just invest 100K in each. So your options and opportunities just skyrocket. It's very interesting how we've been working with a lot of smaller aggregators, for example, that they want to fundraise in a couple of months. But then when they first start, they don't have a track record yet that is solid enough for the valuation to be attractive, or for their equity to be more or less protected. So they'll come to us instead. We've been working a lot with Telos brands, for instance. I don't know if you heard about them. They started around a year ago. They financed their first acquisition with us just a year ago. We recently just financed their 5th acquisition for over $1 million. So these guys now have a track record. They can go and knock on the VC's door with already a solid portfolio. They didn't have to dilute themselves. They didn't have to put in risk any personal guarantees. They could just do our revenue-based lending model. And because our loans is always focusing on the target and the deal itself, whenever you apply for an acquisition loan with us, all of the terms will refer only to that acquisition you're doing. So all of the other companies in your portfolio will have their own terms and will be protected against all of the other loans to be sent in a way. And by the way, I'm just going to send my email now here in the group chat. Feel free to reach out if you have any more questions, or if you want to check a company or whatever. That's my email there.
Oh, that's really helpful and very much appreciated.
Anything. So the products that are outside of our lending scope would be supplements, as we already said, jewelry, fashion, basic electronics. Those again are just because we don't feel there's, so imagine, right? Jewelry or fashion. they depend very much of the taste of the owner themselves. So if now the owner is changing because the seller is selling and the buyer is buying, if the buyer suddenly changes the style or the product goes out of fashion, is it still going to be sustainable for the next 5 years? We don't have the security of that, and we're lending long term. That's again why a lot of buyers find it very useful to work with us as partner analysis, because if we're approving something, we're taking a chance on it long term, not short term. So we want to make sure that if the owner changes, the taste will still be the same. Now, there's also basic electronics, basically because Amazon can just come up and launch something way cheaper, and then we're all screwed, in a bad way of saying. Then other products that are also out of our lending scope, following up on that, we don't usually mention them in calls, but since we're here, and these are more because of philosophy, etc. Weapons, I never pronounce as well, weapons, tobacco, pornography, gambling, those ones we also avoid for obvious reasons. Basically, the big difference, okay, between Boopos and Pipe or all of the revenue-based lenders out there, those guys are great if you want to do working capital. They're going to give you cheaper fees. IRP will be the same at the end of the day, but the fees will be cheaper. So at first it's like, hey, good terms. Now, however, they're doing working capital, they're doing growth. So it's a completely different scope. We can also help with growth, but that's not our core product. We're focused on acquisitions. So all our terms, all our facilities are oriented to acquisitions. That's why these guys will usually give you 60% more or less. We can go up to 80%. So our facilities are bigger. And then the big difference. So they're doing working capital, we're doing acquisitions. Our facilities are bigger just because the objectives are different. And of course, you need more to buy a company than to grow it. And then we go long term. This is what's really interesting, especially if you're trying to acquire a company. I was just on a call last week with a buyer that had financed the acquisition of part of his company to his partner using a revenue-based lender short term. The IRP was very similar to the one we offered, but he came to us and he was like, crap, I want to refinance with you because I have to pay these guys off in just a year. And that's really drowning me. I can pay you guys back in 5 years. I need that extra time to grow the company and to pay it easier and to not have to stress about it. So that long-term aspect is something that weighs a lot.
So could I ask a clarifying question? Stephen, did that
Please.
answer your question? Sometimes our members will have working capital rolled into their loans when they do SBA. And so how do you handle working capital when you're lending on acquisitions in the e-com space?
Yeah, pretty straightforward. So basically, you first acquire the e-commerce with us, for example, or the SaaS or the Amazon business. Then you come back, you've been paying your royalties, everything well, you just need to roll up that growth loan. We can do that also with different terms. I don't know them by heart because it's a product that we reserve for partner buyers, and that is more under our underwriting team. But basically, it's more like a bullet loan. It's very similar to the other revenue-based lenders out there. It's between 1 year, so very similar to any growth loan out there. You just go, you get your money, you acquire the inventory or the market, and then you pay it off, and you're free to go.
So is it safe to assume that if they're buying an e-com business, that like inventory and working capital are two of the things that get tacked on at the end a lot of times in transactions? And so is that something that they would have to fund themselves, or does that, right? Because
yeah, usually yes.
Okay, so worth noting, right? One of the challenges, go ahead.
And also, Chelsea, something that we take into account on our underwriting model is advertising costs, marketing costs. So we do not fund anything that has more of a 15% of tacos, of advertising spend, etc. So we also take care of that, and we also look into the cost of goods sold. So we do take that into consideration in the underwriting model. And then usually, yeah, the inventory is something that is factored on the side of like the purchase price will be this, and then that additional of inventory. And then they'll come to us and we'll negotiate the loan.
And so because the inventory and working capital is often in addition to the purchase price, and they're infusing their own capital paired with your financing, do you find that their contributions plus your contributions and any other lending that they have lined up covers that? Or is that something that they need to plan to have covered in addition to using revenue-based lending?
We talk about it directly. They'll be like, hey, purchase price is this, inventory is this. can I apply for a bigger amount, for example, to cover it? We'll go to the underwriting team if we think that's sustainable. Again, we're people behind Boopos, so it's just a matter of talking about it. Buyers will just factor it in and say, this is the purchase price, this will be the inventory, so I'm requesting this loan amount. And then we'll try to max out the amount we can lend with a minimum royalty so that it covers the most possible. That's like the recipe of the Coca-Cola. We don't share that. We share the conclusions, we'll explain, and we're always happy to expand. If we're like, hey, we didn't approve it, or we approved it because of this, this, and that. And we're always happy to talk about it. But the recipe of the Coca-Cola is secret. So the underwriting model is very internal. To be honest, I haven't witnessed any problems in this sense. Again, usually it's just, you would have to establish an LLC for, usually that's how buyers do it, right? They just establish an LLC for the business they want to acquire in the US. We transfer the money there, and it's as simple as that. Then you can just acquire a company wherever it is in the world. So I'm not aware that we've had those complexities or those issues. But again, I'm not aware of it. I don't know if it's 100% that we never had it. I know that buyers usually find it pretty straightforward and very easy. We haven't had complaints about that during the closing process, at least not yet. If you have a deal you're thinking of in mind that we would be able to help, I just encourage you to submit it through the platform. That's like very easy. It won't require, like, it doesn't take more than 5 minutes. You just need the profit and loss statement and the link to the storefront or the cohort triangle analysis if it's a SaaS. That will kick off the project, and then our closings team will be there for you in case there would be any problems. And that's when you can bring up that kind of questions, like submitting the deal to get feedback. That doesn't have any price or any cost. It's no commitment. That's also why we encourage buyers to just establish the LLC in the US to avoid that kind of problems. Precisely. Thank you for clarifying, TLC.
Any other question? Did that answer your question? No, Michael?
Okay.
Any other questions? One other question that I had was around every lender typically has fees associated with lending. SBA has a guarantee fee. Lenders have fees. Do you guys have fees in addition to the loan amount?
Glad you asked. I always forget to clarify that, and that's a very good point. We have an opening fee just once you open the deal of 2%. That is not an upfront payment. Important. That just means that you'll be receiving the facility minus 2%. Easy as that. So if we're giving you 100K, you'll receive 98. That's it.
Okay, I'm following. Any other questions? And 2% is of the total, like, loan package.
Our facility, exactly. So it's our lending amount. It's 2% of our lending amount. That's why if you're borrowing 2%, I 2%. If you're borrowing 100K, we'll be transferring you 98.
Okay. Any other questions?
I think Michael might have another one. His hand is raising. Okay.
Thank you so much, Andrea, for taking the time. I hope this was really helpful to you guys.